So the question for today is, what is a home equity line of credit? The reason why this topic came up is I was in conversation with someone the other day, and they mentioned they don't have a mortgage, but they have a home equity line of credit. Those two terms get interchanged a lot. People think that a mortgage is just a traditional 30-year, my payment's this, all those things. The reason why it's referred to as a mortgage is because mortgage is what is filed against your house when you borrow money against it. So at the courthouse, the bank or financial institution files a mortgage, which is their security. So if you don't pay the loan back, the financial institution can theoretically take your house. Not really theoretically, they can take your house if you stop paying. So a lot of people say, well, I don't have a mortgage, I have a home equity loan or home equity line of credit. So what a line of credit is still a mortgage. When you apply for a home equity line of credit, it is still a mortgage. The financial institution will file a mortgage against your home. The difference is, in a home equity line of credit, traditionally, they are not a fixed rate. They float with a margin on a index. So prime rate, for instance, is typically the most popular one. The payment can change over the life of the loan. Now there's different types of home equity lines of credit. There are some that, let's say for instance, you have a $20,000 home equity line of credit. You may be able to lock a portion of that in at a certain interest rate multiple times. So if you have a $20,000 line of credit and you lock $10,000 of it, that means that $10,000 of it for 3 years, your payment will be the same, your interest rate will be the same, and at the end of 3 years, that balance will be zero. Now, if you don't lock those in and you have $20,000, if you borrow the full $20,000, your payment will vary depending on interest rates. Now, for the last 8 years leading up to 2 years ago, interest rates were relatively flat. They didn't go anywhere up or down. After 2008, interest rates stayed low. Recently, within the last 2 years, 2.5 years, interest rates have started to go up. In your normal, traditional, fixed rate loan, your balance is here, let's say $500, that you borrow. You pay that back over a period of time at a certain interest rate. If your interest rate is 5%, let's just throw a percentage out there. And for $500, let's say for a time period of 1 year, all right? I don't know exactly what that payment would be, but let's say that payment is $50. And again, these numbers aren't going to be right because I don't have a payment calculator in front of me. But, so your payment for that whole time period is going to stay $50 because your interest rate stays the same and the amount you borrowed stays the same. Nothing changes in that whole time period. So at the end of that time, let's say a year, that $500 will be totally paid off. So you will have paid the financial institution $500 plus 5% of that money, which would be a total of $525 would be your total amount. Okay? So that's fixed. Now, what a line of credit is, traditionally, is a variable rate. So, in a variable rate loan, you still have your interest here, and you have your time here. The difference is, if you borrow that same $500 on day one, a lot of times the lines of credit don't set a payment term. They're kind of like a credit card. So you could have a $1,000 balance, but your minimum payment is only $10, let's say. You're paying a principal, or you're paying the interest and a portion of the principal off every month, which is how a line of credit is set up. Now, some lines of credit, depending on financial institution, will make a predetermined amount of payments. But that doesn't mean that it's a fixed rate. So let's say this $500, your initial payment is $50 a month. Okay? Now let's say, for instance, your interest rate was 5% here. A month into your loan, your interest rate goes up to 6%. Your payment is not going to be $50 anymore. It's going to be, let's say, $52. Because you're compensating for that difference in interest rate. If they didn't do that, if it is a termed loan, meaning at the end of a period of time it's paid off, that's how it will adjust, similar to that. The difference is, if this is a $500 loan, you pay $50 a month, but you're only paying just the interest of the loan and a portion of the principal. At the end of this time period, you may actually owe $400. Very similar to credit cards. Even though you're paying the minimum balance, the minimum payment, at the end of the time period, you're still going to owe money. And this is where it gets tricky with lines of credit, because with interest rates fluctuating like they have in the last 2.5, 3 years, your original line of credit on your house back in 2008 may have been 3%. And now it's 6%. So even though you continue to borrow, continue to pay this loan down, make these payments, your payments are constantly going up based on that amount outstanding, because they take the amount of money that's outstanding. So let's say in the beginning, a couple months in, your outstanding balance is $475. Okay? Now, you pay 6% divided by 12, which is how many months, times the $475, that's how much interest you're paying. So your payments could go up significantly if interest rates rise. This is why an advantage is to only do fixed rate loans, or if there's an option to lock in that line of credit, make sure you do that. This is one of those topics where it's very hard, because I'm not saying that the financial institutions don't tell you this is how it is, but most of the time they just assume that you know what these products are. That's why I wanted to do a video like this, because there are people that don't know that a line of credit is actually not a fixed payment, that it'll go up. And a lot of times, if interest rates don't go up too much, you won't notice. It's just a couple dollars here and there, but over time, it can change significantly. So that's basically what a home equity line of credit is. It's still a mortgage. There's still a mortgage filed against your property, your house, or whatever. It's just the difference is usually that floating rate versus a fixed rate loan. I'll go into another video is going to be how they calculate what equity you have in your home. So I hope you enjoyed the video. If hopefully it spawned some questions or got you thinking, and if I can help in any other way, please leave a question or a comment. Thank you, and have a great day.